Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today advises clients on the use of self-directed IRAs and solo 401ks for real estate investing and lending. Bernard Reisz is the principal of Reisz Financial. Bernard, welcome to Purchase to Profits. It's great to have you on the show.
Seth, thanks for having me on. I've been looking forward to this and looking forward to the show.
Yeah, so my pleasure is all mine. So you are the guy to talk to about optimizing your tax strategies. So where do you want to take this to begin with?
There are so many different angles, so that's an awesome question. And the key thing that I try to convey to everybody is that every single dimension of your investment and tax strategy has got to be integrated. So you can kind of start at any point, but you've got to think about how does that integrate with all the other points that we got to hit. What I think is a good place to start is to talk a bit about different entity structures. Just a brief recap, talk about the tax and legal integration, how that interacts with having a 401k or IRA. And then that'll probably lead to so many other questions. It's like open a Pandora's box.
All right, let's do it. And we'll have to make sure this is less than 5 hours long. So,
okay.
All right.
I think I'll just kick it off with what I see is often like a misconception. People will say, okay, Bernard, or I'll see this on the internet, or I'll see it on a podcast or some forum. I was wondering if I should form an S Corp, C Corp, or LLC. Mm-hmm. So when I see that kind of question, I realize right away there's a kind of a jumble of concepts that are being tossed around that are really distinct from each other. So you can have an LLC that's an S Corp or a C Corp. So it's not like should I have an LLC or a C Corp? There are two different sets of questions that you have to be asking yourself. You have to be asking about your legal structure and about your tax structure. And to a certain extent, those can be mixed and matched. So on the legal side, you got to think about, do I want to be a sole proprietor, a limited liability company, a corporation, or some form of partnership? General partnership, limited partnership, and then there are many other permutations of these. To kind of keep it simple, there's the legal side, sole proprietor, partnership, limited liability company, aka LLC, or corporation. Mm-hmm. Then there's another set of questions you've got to ask, which is your tax structure. Do you want to be taxed as a partnership, as a sole proprietor, as an S Corp, or as a C Corp? So there's the tax structure and there's the legal structure. And to a certain extent, you can have any of the legal structures that we suggested and have any of the tax structures. So you can have an LLC and have it taxed as a sole proprietorship, partnership, S Corp, or C Corp. Mm-hmm. You can have a corporation and have it taxed as an S Corp or C Corp. So you have to ask, what legal structure do I want? And separately ask, which tax structure do I want? Because those are, to a great extent, independent questions, and you can mix and match. Does that make sense?
That makes perfect sense. And if somebody's wondering about the legal side, we did a great interview with Garrett Sutton, the Rich Dad advisor, on the legal implications of structure. So that's a nice little pitch to a past interview.
Oh, yeah, and that must be a great episode, and they definitely should check this out. I don't want to take it too deep a dive, but definitely enough that this should be a self-contained episode.
Yeah.
So in general, for the most part, we're going to go with an LLC. And we do set up LLCs for our clients, and then we'll decide which tax structure it should have. Because if an LLC is really the most flexible entity, an LLC can have any of the tax attributes that are out there. So in very limited cases, do you want to use a corporation? And from an asset protection perspective as well, an LLC is usually going to be more beneficial than a corporation. Yeah. So when somebody says, should I have an LLC or an S Corp? In my mind, that's like, you should have an LLC. Then the question is, how do I want that LLC taxed? An LLC can be taxed as a disregarded entity or sole proprietorship, partnership, S Corp, or C Corp. So what are those different tax structures? What are the different attributes of those? So it's good maybe to start at the far ends and the two extremes and then work our way towards the middle. At the far end is the C Corp. which is perhaps what people most often associate with corporate taxation. So a C Corp will have what we call that double taxation. Now, in many instances, it may be wise to use a C Corp. And there are many tax strategies that incorporate using a C Corp and can have many, many advantages. However, in your plain vanilla case, C Corp is not going to be the way to go. Because although a C Corp itself will have the lowest, a very low tax rate since tax reform was implemented, C Corps get taxed at a flat 21% rate. Whenever there is a distribution to the C Corp shareholders, to the owners of that entity, they will be taxed again on those distributions. And when you stack the two layers of taxation, one upon the other, your effective tax rate is going to be higher than it would have been were you to be use the other structures. Now, that being said, C Corp definitely has its place. And there are many ways where we can use a C Corp to defer taxes or eliminate taxes. But in your plain vanilla scenario, C Corp is not going to be the way to go. Mm-hmm. Sounds right? Does that jive with what you've heard?
And I would just say, if anybody out there wants to pay more tax, you have to go and get your head checked out. So we always want to minimize tax, especially with real estate, because real estate has all these amazing tax benefits.
Yes, real estate is the most tax efficient investment out there. You've got so many deductions, and then, while you're holding the property, obviously you got your depreciation. You can accelerate it with cost segregation. And when you dispose of the asset, there's a whole new set of strategies that you can use to reduce your capital gains tax. So real estate is definitely a very tax efficient. You definitely generally don't want to hold that in a C Corp. And there are a couple of reasons for that. The way corporate taxation goes, if you want to refinance, you're going to have some issues. So generally don't hold your real estate in a C Corp, but it does have its place. Mm-hmm. At the opposite end of the spectrum, we've got what we call sole proprietorship taxation. And a single member LLC, which is an LLC that is owned by only one individual or by married individuals in a community property state, can be taxed as what we call a disregarded entity, which means the IRS essentially just looks right through that LLC. You have the legal structure in place, you get the legal protection, but from a tax perspective, it doesn't exist. So when people say, and you hear from people, Bernard, I just got to get my LLC set up because I got to save on taxes. Your LLC it's non-existent. If it's a single member LLC, by default, it's invisible. The IRS doesn't even see it. It does nothing for your taxes, but you'll use it for asset protection. And in that case, people that maybe never had a business, they know they do a personal tax return, they're 1040. If all you have is a single member LLC that's a disregarded entity, again, you'll just be doing a 1040. You'll have a Schedule C, just as you would if the LLC did not exist. All the income from whatever's going on in that LLC just flows right through to you as if the LLC did not exist. Mm-hmm. The intermediate structures we'd call that are kind of something between the C Corp and the LLC disregarded entity are going to be your partnership and your S Corp. So there's kind of a continuum. At one end, you've got LLC disregarded entity, partnership, S Corp, C Corp. That's kind of the continuum. So a partnership is also a pass-through entity. From a tax perspective, to a great extent, it's invisible. And you can have a partnership with or without an LLC. So if you have a partnership, you still want to put in an LLC, perhaps for asset protection. A partnership has its own tax return. You're going to do your Form 1065. You're going to get your K-1. There are separately stated items, some items that are deducted at the partnership level, some things that flow through as separately stated to the partners. But for the most part, the tax is very similar to an LLC that's disregarded, except that it has its own tax return. The IRS does see the partnership. It's not invisible, but you kind of still get that total pass-through treatment.
Yeah.
Moving up in the spectrum, then you get your S corporation. So an S corporation is the closest thing that you get to a real hybrid. When we talk about corporate entity from a legal perspective, What's unique about a corporation is that it stands totally apart from the owners, from the shareholders, right? So you think about your big publicly traded corporations, they have shareholders, but they're at home sleeping. They own the shares. They don't do anything. Nobody asks them anything about the company. They get distributions from time to time, but the company itself, it has a board of directors. It has officers, a CEO, COO, CFO, and they probably never vote anyway. Shareholders technically are entitled to vote, but it stands completely apart from them. And that's why in your C Corp structure, which is kind of your default tax structuring for a corporation, there's no taxes passed through to the shareholders. The company stands on its own. The company, say, has profits. They made $1 million. The company pays that profit, that flat 21% that we refer to, but the shareholders pay no taxes. If the company officers and board of directors decide to issue a distribution, the corporation says, okay, we made a lot of money. We think we should give something to shareholders. So we'll distribute $1 million to the shareholders. At that point, the shareholders have income. But up until that point, there's no income to the shareholders. A company can theoretically make millions of dollars every year, and the personal tax return of the shareholders will not reflect any of that income. The 1040 will not have anything.
Yeah.
At the point at which the corporation decides they're going to make a distribution, at that point, they're going to pick up some income as a distribution dividend from the company.
Yeah.
So how does an S Corp work? What is an S Corp vis-a-vis a C Corp? So S Corp has some of the attributes of a corporation and some of the attributes of pass-through taxation. So with an S Corp, profits are immediately passed through. So if something gets taxed as an S Corp, made $1 million, that $1 million is going to show up on the shareholder's income tax return. We don't have to wait for the company to make a distribution. It automatically flows through. However, at the same time, the IRS says, we're going to treat this as kind of standing apart from the owners, and the owner can be an employee of the S corporation. So in contrast with a partnership or a single member LLC, you can't set yourself up as an employee of your single member LLC because you and your LLC, you and your company are kind of indivisible. You're one and the same. From the IRS's perspective, you can't hire yourself, right? So if you're a sole proprietorship, you don't have any entity, you can't give yourself a W-2. Likewise, if you're a partner, you can't be an employee of the partnership because you and the partnership are one and the same. But if you have an S Corp or C Corp, then you can be an employee of the company. So with the C Corp, it's kind of obvious because it totally stands apart. An S Corp, profits pass through, but if you're going to do work for the company, you're going to do that as an employee. You're going to run payroll. You're going to issue yourself a W-2. So that also allows for lots of creative tax strategy, which the IRS is very wise to, so you want to craft it wisely. But to recap, you've got your disregarded entity, sole proprietorship, moving up the continuum, more to kind of seeing the entities apart from the owners. You've got partnership, followed by S Corp, and that's followed by C Corp. What do you say to that, Seth?
Makes a lot of sense. I hope everybody's taking notes. Once in a while, I'll get somebody email in and ask a question saying, hey, I'm just starting out. These are the types of properties I want to acquire. What sort of structure is best for me? Is there one structure tax-wise that works better for, let's say, a flipper versus a small multifamily owner? Are there any rules of thumb that you use?
Yes. But the caveat here is rules of thumb are just that. They're just rules of thumb. And every situation can be different. We see that all the time. And that's kind of the risk of somebody going out to the internet, Googling and getting the answer. It is true that if you're really good at research and you're savvy and you understand what you're doing, you can oftentimes get the right answer from the internet.
Or you can just pick up the phone and call you.
Yes.
Right.
The context I'm trying to provide is not always will you benefit. The benefit you may get may just be, hey, okay, reinforcement, confidence. But it's worth asking the question, because it's those unknown unknowns that can kind of trip you up. So if you just go to the internet, it's good to get a great education, learn the concepts, but you shouldn't be disappointed if you call a CPA and they say, yeah, that's what you should do. You're like, why'd I pay him? I could have just done it myself. The answer is, if that CPA is one that is knowledgeable about all the moving parts, there are things that they're taking into account that you did not take into account. And a story that I just had is actually a CPA that's a client. So this is a person that is a CPA, very financially savvy. They're not in tax. They're more on the financial side, auditing, financial advisory, CFO services. But this is a CPA. So they have a very solid handle on everything tax. Mm-hmm. And we were setting them up with a 401k. And then all of a sudden we saw what was going on their structuring side. And we just kind of conveyed to them, we said, hey, this is not part of our service, not something that we're involved in, but FYI, you probably should rearrange your stuff there. Initially, there was some pushback. And they even said, I'm a CPA, and I also have attorneys and CPAs that I work with, that I hired to help me with this. And our response was, that's cool. We know not to go what we weren't engaged to do. But if you want to, we'll give you a consultation. Mm-hmm. And yes, we did that. It just took a half an hour. We talked them through it, and we got them totally restructured. So there are things out there that can trip people up and cost them tens of thousands of dollars in taxes if they're not careful.
Oh, 100%. And that's one of the things we really push on the show is, if you're getting into real estate investing, you have to treat it as a business from day one. And that includes paying for professional advice from the right people. You can't be cheap and just go to the internet if you're running a business. A business owner goes to a professional who has their niche or niche that they specialize in, and they will pay because that will save them a ton of money down the road.
Yeah, well said, Seth.
Yeah.
And ironically, some of the kind of internet-based providers that you're going to get, you can actually end up paying more. Like the way we've structured ourselves, we try to make it easy for people to make choices to work with us, provide great value at a great price. Ironically, if you go to some of the internet-based services, you can end up paying more. Once they bundle all the different things, they cross-sell you, you may come out ahead working with a professional.
Yeah, no, for sure. So let's move on to how somebody can use their, let's say their 401ks, self-directed IRAs to get involved in real estate investing if they've never bought a property before, but they're thinking about it.
Yeah, let's do it. And we'll kind of tie it together with everything we discussed up until this point. So on the 401k side and IRA side, we use different structures. Let's focus for a moment on the 401k side because it does tie in better with some of the other stuff we're talking about. So there are two things that we have to think about when somebody's using tax-sheltered accounts for real estate. We've got to think about where the money is coming from, because generally it's going to be coming from a 401k or IRA of some sort. And then what kind of structure are we going to set up to them to maintain the tax-sheltered status of that money, but allow them to direct it into real estate investing in a way that's really cost-effective and really flexible. So what we do is we set up retirement accounts as well. So they're going to be coming from a 401k, and we're going to be setting up either a 401k QRP structure for them or an IRA to receive those funds as a tax-free rollover or transfer. Then they can use the structure that we set up to invest in real estate, unrestricted. Because the IRS, I guess let's dwell on this just for a moment. It's just in case people are not familiar with this. We've kind of got to shatter any of those misconceptions. Any restrictions that are imposed by your IRA or 401k administrator or custodian are purely artificial. The tax code says nothing about investing your 401k in a menu of mutual funds. It's just completely silent. Tax code says don't invest in collectibles, and for IRAs, don't buy life insurance on your life. Other than beyond that, it is silent, totally silent about asset class. So the IRS does not say invest in mutual funds or Vanguard is better than Fidelity. If it doesn't say you can't do it, then you can do it. The IRS is just interested in telling you invest for your future. We'll give you tax benefits. We'll give you incentives. We know Social Security is not going to support you. We got to get Americans to put money aside for the future so they can pay for retirement. And then we're going to leave it to them, and we're going to trust them to figure out what's best for their financial future. The IRS is not against financial self-determination.
I'm glad you clarified that, because I think one of the biggest shames out there is, people, when they're looking at their options, they go to their financial advisor, who will then, introduce them to mutual funds. But most financial advisors either aren't knowledgeable about real estate, or they don't push it because they don't get paid on that side of real estate. So really glad you clarified that and made it crystal clear. Real estate is 100% okay to invest in.
Yes, I couldn't say it with more emphasis. And I've perhaps is a little bit of the reason why I feel it has to be emphasized is because one of the things we do, we help people kind of beginning to end. Our clients end up with their money in a bank account from which they can just write a check to invest. And that bank account's got to be at a bank. We've got relationships with bankers that know exactly what we're out to do, and they get our clients, they give them great service. We make those introductions, and the accounts are just set up in no time. But we also give clients the option of using any bank of their choosing, and we'll work with them on that. And what happens is they'll go to the bank, and although we tell them less is more in this scenario, don't tell them exactly what you're doing. Sometimes it emerges. And they hear something about IRA 401k, and they're like, oh, we got just the person for you. And they send them over to their in-house financial advisor, and they start talking. And then I get a panicked call. Bernard, I just spoke to a registered financial advisor, and he says I'm going to go to jail. If I do this. So this is legal. There's just not enough education out there about that. And frankly, I'm not out to bash that industry. It has its place, but the people that are brought up through that system, for the most part, are never taught about this. Many of them don't know that it exists. If they do, it comes along with kind of a cheat sheet that tells them, here are all the reasons why you should not do this. And they'll pass it out to their clients. I've had that as well. They've got this prepared cheat sheet. Oh, read this. And then I also got this call, Bernard, my financial advisor just said, don't do this. This is terrible. We've got to allay their fears. But as you say also, they're certainly not going to bring it up. It's just not part of their business model. And I don't expect them to bring it up. It's just not part of, you go to an analogy that I like to use. When you go to a Chinese restaurant, they're not going to tell you, you can get great French cuisine at the French bistro down the block, right? You're going to get what's on the menu there. You've got to open your eyes. You've got to walk around the block a couple of times, walk the neighborhood, see what the options are. You don't expect the folks at the Asian restaurant to tell you that there's Mexican food or French or something else down the block.
Yeah, you'll just get loaded up on chicken balls.
That's it. And that's great. I'm not against that. I love Asian food. Yeah. But if you want, you've just got to understand that when you go to an advisor, they're going to give you what they've got. Yeah, that's the name of the game. Yeah. So to continue with now that you've kind of walked around the block and you've learned that you can get your 401k into real estate. So what we want to do is ideally set you up with a 401k to receive that. So a 401k is a type of qualified retirement plan. They go by the abbreviation QRP. There are many types of QRPs. 401k is the one to use for real estate. The 401ks that we focus on setting up are owner-only 401ks. Now, a QRP has got to be tied to a business. So we're looking for folks that either have something that's structured as a business or can be moved into a business. Business does not mean LLC or corporation. That's all legal stuff, as you spoke about. When the IRS wants to know if you have a business to create a 401k, they don't care about your legal structure. That's between you and the state, right? Legal entities are coming to existence by statutory authority. There's that's a state statute, and you can do business. You can have a real estate business, consulting business, and you can create an entity for that. From the IRS's perspective, you want a QRP, you just need a business activity. So we're looking for some sort of business activity. Then we can create a 401k for that business. And again, part of that part and parcel is, all right, but you've got a business activity. What kind of entity structure do you have for that? From the perspective of actually creating a QRP 401k, it can be any of the business entities that we spoke about. But this is where we get to see and optimize the structure, because there is an incredible interaction between these. So on the QRP 401k side, you could actually use those to get between $55,000 and $125,000 per year in tax deductions. Super tax efficient, super tax deductions, really turbocharge your deductions. But what people often have is an S corporation, or they got to the internet told them, or even they asked a CPA. This is one area, frankly, most CPAs trip up. CPA will tell them, get an S corp, because S corp will save you money on payroll taxes. That is true. But that S corp is going to may just totally annihilate your 401k deductions. So you've got to find the right balance. You've got to take all into account. And without taking too deep a dive, since tax reform, you've got to think about your QBI deduction. That's your 20% pass-through deduction. You've got to think about your payroll tax strategy. And you've got to think about your QRP 401k tax strategy. Bring those all together. There's an incredible integration between those. And based on that, you'll know which entity selection is best for you. So we can mix and match the 401k with any type of entity structure. But if you've got an S corp in place, or you may be getting an S corp, you may be doing harm. That may keep you from maximizing your QRP 401k tax deductions.
Yeah. And I was just going to ask, let's say somebody has an S corp already set up. Is there a way, they can kind of reverse the damage and get themselves into a new setup?
Yes, there are multiple ways that you can do it. The IRS in general is very wary and leery about S corps. So let's talk about S corps for a moment and what kind of tax strategies you generally can get with an S corp. People think of taxes, they immediately think of income tax. But there are many other types of taxes that you're paying. And most notable among them is what's called FICA and FUTA. FICA, you've got FICA, FUTA, SUTA.
Sounds like cheese.
Yeah. AKA payroll tax or self-employment tax. So somebody's transitioning from a W-2, they'll know, they look at their pay stub and they look at their annual W-2, they'll know that on box one it says their income for this. Then there's going to be income tax withholding, FICA withholding, FUTA withholding, what were their Social Security wages, their Medicare wages. Some of those are impacted. You may have made a 401k contribution, deferred some comp, and that will impact the flow of the numbers. But should be wise to the fact that there's another tax that is being withheld other than the income tax. There's the payroll tax. And when you work for a company, your W-2 is going to withhold, with portion of that tax is paid by you, withheld by the company on your behalf, and half the tax approximately is paid by the company. So you're paying half, and the company that hires you is paying half. So that company, be a sole proprietorship, S corp, whatever that is, they're responsible for half of that tax. Mm-hmm. Say you move over to have your own gig, side hustle, or you're gone into business for yourself. You're becoming a consultant. Well, now you're responsible for that full tax, and it's called self-employment tax, right? Again, we don't have another entity to pick it up. We don't have somebody else that owns a company to pick it up. So you pay the entire 15.5% as self-employment tax. So what is often recommended as a strategy to mitigate self-employment tax? Create a corporation of some sort, and usually it will be an S corp just to avoid that double tax. Mm-hmm. So when you have an S corp or C corp tax structure, then you get hired by the company, right? You're no longer working for yourself. From the IRS's eyes, you're working for the company. And people that work for another entity, work for a company, are employees of that entity. So then you hire yourself, you run payroll very much as the way it was run when you work for somebody else. And then you can determine how much you want to pay yourself. So if your company's profits, say, were $100,000, you may choose to pay yourself a salary of $50,000. and you'll only have payroll tax liability on the $50,000. Just like your old employer only had payroll tax liability on the $50,000. Everything else was just profit and was not subject to payroll taxes. So in an S Corp, you may think, hey, this is really neat. If I was a sole proprietor, I would pay payroll tax on the full 100. I hire myself as an employee, do the S Corp thing, give myself a $50,000 salary, and I just eliminated payroll taxes on $50,000.
Yeah. And if somebody's going out there trying to get financing on a single family home, the banks tend to like W-2 employees a whole lot better.
Yes, absolutely. Self-employment, they don't have that much confidence in that. They want to see consistent W-2 income. They kind of feel more secure about that. That's an awesome point.
Yeah.
But
awesome.
What happens now that you've got this S Corp? So this sounds awesome, right? You just saved yourself a whole bundle, right? The IRS is well aware of the fact that people can do this and do this. So a few things that you got to be aware of. Firstly, as an S corporation, you're going to have to file an 1120-S, which means you have a new business tax return, which is going to cost you, you're probably just having that tax filing will more than double whatever you're paying for your annual tax preparation. CPAs tend to charge more for a business tax return. Beyond that, you have to run payroll, right? That costs money. And again, you're going to be paying for running payroll. Beyond that, you're going to have excellent books and records. You can't be messy. You should have good books and records anyway. But over here, in order to do your business tax return and keep the IRS happy, you're going to have meticulous records, which is, maybe I should say, have an S Corp and get incentivized to do that. But the consequences of making mistakes or having errors are much more severe. If you miss a payroll filing, you're looking at penalties, very severe penalties. So you have to just get squared away with your state government about having workers' compensation insurance. Again, these are all navigated, but they're a headache. They cost money to have your CPA do, so they're definitely great for your CPA. But for you, it's definitely going to cost you more money, more nuisance. And sometimes when you have these small companies where it's just the owner, these things may be overlooked. But the IRS is not going to forgive you because it's only you. They want their papers. And if they don't get their papers, they charge penalties. So what you have to, right off the bat, you got to look at is, okay, yes, you'll be saving taxes, payroll taxes, $50,000. But what's it going to cost me in terms of out of pocket, just hard cash that you're going to pay for services? And what's it going to cost you in terms of paperwork and
just your time and stress? Yeah,
exactly. Dealing with that. So CPAs love this. There's really no downside to them, right? For them, it's just more work. But for you, you kind of got to get into this and say, what am I going to pay for this? And so what's my net benefit? And is it worth it for that net benefit? Mm-hmm. And now quantifying that benefit, you've got to figure out how much am I going to pay myself, right? Okay, the company makes $100,000. Am I going to pay myself nothing? Or $99,000, right? If you pay yourself $100,000, you haven't saved anything. If you pay yourself nothing, you're cruising for a bruising with the IRS. So the IRS is very cognizant of this. They say you've got to pay yourself a reasonable salary. Well, if the business is just you, who's generating most of that income, right? The IRS wants to look at, okay, if you were working for somebody else and doing this, what would they pay you, right? It's more complex than that. But they're really trying to say, hey, what's this really worth? And if you're a consultant, very often, the answer to that may be most of what you're earning. Okay, now, there's no table that automatically triggers the tax return, doesn't allow you to file it if you paid nothing. So you can file it. You can be aggressive or conservative. You got to get comfortable with it. But you've got to realize that the IRS is aware of this, and it's something they look out for. So if they think that you're paying yourself too little, they may be coming after you one day, and then again, it's taxes and penalties.
Yeah.
So you got to figure out what the net risk-adjusted benefit is. Now, beyond that, the strategy is worth more the more aggressive you are. But here's what happens. The more aggressive you are on your payroll tax strategy, the less you can contribute as tax deductible contributions to a 401k, right? So if you got this really aggressive S Corp thing, you made $100,000 and you're paying yourself $10,000, guess what? You can only contribute about $9,000 in tax deductions to the 401k. But had you not had the S Corp strategy, well, you could contribute something closer to $30,000 or $40,000 in tax deductions. So by being aggressive on the S Corp side, you just gave up income tax deductions. You just gave up QBI 20% pass-through deductions. So your net savings actually may be nil. But CPAs generally, and certainly the internet, is not wise to think about, oh, you may have this unique structure. You may be setting up a 401k with Resure, and you can get income tax deductions of $50,000 that you're going to lose if you do this S Corp strategy. So it really is, it all comes together. But, I guess I can't emphasize enough. Integration. Unknown unknowns, comprehensive and integrated. Make sure you got all your bases covered.
Yeah, no, 100. That's such a good point where, it comes up in many different places in real estate. You can either take, a short-term gain or a long-term gain. It's kind of, you have to weigh the benefits of both 100%.
So it's multidimensional. Those some of the terms I love to use. Multidimensional, integrated, because everything. We started this conversation with Bernard. Okay, where should we start? And as I said then, I hope is evident now, it's not like sequential. You start at first base, you get to second base, third base, then to home. You've got to be thinking about all those bases from the get-go. Get your entity structured optimally from the beginning in a way that integrates and takes into account your unique structure, your unique profile, your unique appetite for risk, what you're trying to do, bring them all together and run the bases all at once, so to speak. You don't want to hit a single and then kind of steal second, slide it to third. You got to hit a home run. That's really what it's about. You got to round all those bases at once. You're looking to hit it out of the park. And that way you'll definitely make it back to home plate.
Yeah. And I've spoken with lots of guests where, they set themselves up the wrong way when they first started, and it's always a bigger mess to fix down the road. So if you're looking at getting started in real estate, make sure you get the right advice and structure yourself the right way right from day one.
Yeah, that's it. You can't, and sometimes people will come to us, and very often the way it flows, it's not flowing from the tax and entity structuring side. It's flowing from the 401k side. And we hear people getting set up, and we're like, oh, sometimes they're getting, certain things are very heavily promoted and pitched. And sometimes you can't talk people out of it. We do know we've dealt with enough people that ended up with some sort of convoluted structure, and 3 years down the line and many tens of thousands of dollars of costs, they kind of realized that they probably should have undone it and tried to figure out how do we roll this back. And on the S Corp side, something that I meant to mention. So the IRS does not let you kind of put on your S Corp hat 1 year and take it off the other year. You can't switch back and forth. If you can revoke an S Corp election, but you can't reelect it for 5 years because they understand, the IRS is very wise the fact that people want to use S Corps to reduce their taxes.
Yeah, no, that's a good point. So Bernard, if somebody's looking to get in touch with you, where can they find you online?
I love that question. Two best places, 401kcheckbook.com and agentfinancial.com. 401kcheckbook.com. Check it out. Lots of info, but using IRAs, QRPs, 401ks, life insurance, taking all these tax sheltered vehicles and leveraging them for real estate. Agent Financial is more devoted to broader, integrated tax and investing strategy.
No, that's awesome. Well, Bernard, I just want to say thanks so much for taking the time and sharing this with us. People could have at least 10 pages of notes out of this, so that this was awesome.
Seth, great to be here, and looking forward to doing it again.
Yeah, it was my pleasure. And to you, our viewers, I wish you well on your journey from purchase to profits. See you next time.